Hi, this is Jason Rarica with Yellowwood Wealth Solutions. We want to make a quick video today to talk about a question we're getting from clients a lot recently. That is, you've built up quite a bit of money in a money market position. Is that still the best place to keep your money? And if not, how and when do you exit that position? Now, when it comes to money market, we really break that down into three different sections. So first is the money market meant for an emergency fund, or is it meant for a large purchase that you're going to make in the next 12 to 18 months, like a house or a car, or maybe college tuition for a child? If that's the case, then a money market probably aligns with your time frame and is a good place to go ahead and keep your money. The only thing that we would consider different is if it's for the emergency fund portion of this, then at some point you may want to consider putting it into a longer term CD that might allow you to lock in that rate for a longer period of time than the money market will continue to pay at the rates that it's currently paying at. The second thing that we talk about with clients is paying off high interest debt. So if you think about variable loans right now, as rates have gone up, so has the cost of borrowing that money. So a home equity line of credit or a security-based loan, some of those now are costing 8 to 8.5%. So they've gotten quite expensive. And if your money markets right now are paying you 4.5 to 5%, then considering paying off some of this debt at an accelerated rate could make some sense for you versus what you're gonna get from the money market. Now, what we caution folks against though, is paying off some debt that maybe you locked in a couple years ago that's at a lower rate at a house or a car, maybe it's 3.5%. If that's the case, might not make sense accelerating paying off that debt if you can make more money in the money market. So higher rates, yes, makes some sense. Lower rates probably doesn't make some sense. Now, the last thing that we talk to clients about right now is if you put money into a money market with the intention of putting it in the stock market eventually for your long-term goals, but 2022 was a rough year and you weren't comfortable putting it in with all the volatility, and then 23 happens and the market takes off, but it's only a basket of stocks that have done really well, and you don't know if you really believe the rally and you're not sure you want to put it in, and you're kind of just uncomfortable with the timing of everything. One of the ways that we can mitigate this is using a strategy called dollar cost averaging. And that's just simply a systematic way of putting in the money over a certain period of time. As an example, if you had $100,000 and you wanted to put that in over 10 months to make for simple math, you can put $10,000 in every month for that 10 months. And at the end of the time, all the money would be in the market and you will have spread out your timing risk. You will not have invested all of it at the peak and then had a pullback and then suffered as a result of that. And at the same time, you will not have put it all in at the bottom and gotten the maximum return you could have possibly gotten. You're spreading out your risk over a period of time. And that's just a much more palatable way for most people to get the money into the market if that's what the long-term intention is in the first place. Now, more than anything, we want to caution folks against getting too caught up in the near-term volatility of the stock market and in interest rates that they get so paralyzed that they can't make a proactive decision about what's in their best interest. Talk to your financial advisor or give us a call. We're happy to discuss with you what your long-term vision is and what might be in your best interest so you can spend more time enjoying your life. Because after all, healthy plan, wealthy life. Thanks so much. Have a great day.